Annuities have a well-deserved reputation for being among the most confusing investments, not to mention the most expensive. But if you're retired or close to retirement and you want more guaranteed lifetime income than you'll get from Social Security and pensions, then you might think about devoting a portion of your retirement savings to a particular type of annuity, namely an immediate annuity. The way this type of annuity works is actually pretty straightforward. You turn over a lump sum to an insurer, and in return you receive monthly checks as long as you live. You can even arrange to have the payments continue for as long as either you and or your spouse is alive. The amount you receive for a given sum depends primarily on your age and the level of interest rates when you buy. You can see how much you might receive given your age and how much you have to invest by going to the payment calculator at immediateannuities.com. Now, you might ask, couldn't I just invest that $100,000 on my own and duplicate that income? The answer is that it would be pretty tough assuming you stuck to extremely secure investments that would be sure to pay off. For example, at recent interest rates, you would have to invest about $120,000 in Treasury bonds to generate the same $630 a month just to age 90, assuming interest rates remain stable and that you would be able to sell bonds to help fund payments without a loss. Live beyond 90 and, unlike with an annuity, your income would stop. An immediate annuity does have drawbacks, however, that you need to weigh. In return for those guaranteed lifetime payments, you typically lose access to your principal, so you can't tap that $100,000 for emergencies and such. So you definitely don't want to put all or probably even most of your money into an immediate annuity. One guideline is to invest just enough so that the combination of Social Security and any pension payments plus the annuity income cover most of your basic living expenses. If you're bothered by the idea that you might die shortly after buying an annuity, you can choose options that will refund a portion of your investment to your heirs or continue payments after your death. For example, if you buy a lifetime income annuity with an option called 10-year period certain and you die within 2 years, your beneficiary would receive payments for another 8 years. Of course, such options lower the size of your monthly check. There are a few other things you want to keep in mind if you're considering an immediate annuity. Since you'll be relying on the insurer to make those monthly payments for many years, you'll want to limit yourself to companies that get high financial strength ratings from firms like Standard & Poor's and AM Best. For an extra measure of security, spread your money among 2 or more annuities from different companies. And make sure the amount you invest with any single insurer is within the maximum covered by your state's Insurance Guarantee Association. You can find the maximum for your state by going to the website of the National Organization of Life and Health Guarantee Associations, or NOLGA as it's affectionately known. Finally, to diversify against the risk of putting all your dough into an annuity when interest rates are abnormally low, consider spreading out your purchases over time. Believe it or not, I've sketched out only the basics here. You can find more information in the annuity section of our Ultimate Guide to Retirement. The bottom line, though, is that while annuities can be confusing, and they're definitely not for everyone, an immediate annuity is an option you may want to look into if you find the idea of having more guaranteed income in retirement appealing.